So let me introduce a little bit about Paul. Paul is working in Northon. Northon is a very well-known VC investor and probably is one of the largest investors in Europe and one of the most active investors in early stage. They are a generalist fund, and they invest all around Europe. No? They have a strong focus in the Nordics, but also they have opportunities in different parts of Europe as well. No? And from the Paul perspective as well, he has spent half of his life as an entrepreneur and the other half as an investor, no? And now in Northon. On the other side, we have James. James is a person that is working in the financial industry for a long period of time, and the last 5 years he's in Silicon Valley Bank. Silicon Valley Bank is the bank of the innovation economy. It's a bank born in Santa Clara in California that they are expanding different hubs around Europe. And the kind of relation that this bank is creating with entrepreneurs and with investors is quite unique. No? And James is in charge of these relations with all the venture capital activity, both in the US and also in Europe. So thanks, James. Thanks, Paul, for having us. So you are two different kinds of investors. So one invests in equity, the other one invests in debt. This is like water and oil. So they can both be together in a growing company or not. So this is the question that finally we need to answer during these minutes. But very briefly, I would ask you to say, what is your experience investing in Spain, in South Europe, in Europe, and otherwise, what is your experience combining these two kind of things, no? Between investing in equity and also investing in venture-led?
Yeah, so I mean, I'll start with, I actually, I studied in Madrid, so I have a network here, I have an affinity for Spain, but when I was investing in New York out of a group called BetaWorks, we did an investment here with Kibo Ventures, and that was 6 years ago, 5-6 years ago. So we've really seen, I've seen firsthand what started in a fairly small kind of startup ecosystem grow into this massive, global hub. So yeah, I think it's now Northzone has 3 investments active in Spain. One of our hottest companies, Redpoints, Laura was speaking somewhere here, is based here as well. So yeah, I think for now, the thing we talk about is Silicon Valley has sort of lost its monopoly on startups, which means that we as investors have to do a little bit more work to travel around and find the next great thing.
Yeah, from Silicon Valley Bank's point of view, we're 40 years old. We've been working with the startup ecosystem in California for all that time. And since when we've gone on a bit of an expansion drive. And so we went to London in the early 2000s when the ecosystem there looks a lot like Spain does now, maybe 10 years ago. And so from our perspective, we see the Spanish market as being hugely exciting. There's a lot of noise around it. The funds that I look after and talk to on a daily, weekly basis are all talking about Spain. I think they see value because, to your point, in California, companies are expensive. Valuations are high. That's not quite so true here, but that will, as I'm sure more investment activity goes on, that will probably change.
Okay. So I don't know, James, that you can probably introduce you as a bank, how you are working with the startups, and what is the process that you have, and especially your role with VCs and how you create these deals together, no? Between rounds and how you participate and how you create these syndicates.
Yeah, it's the way I think about it. It's a genuine partnership with the equity investors. Without the equity, there is no debt. So without Paul and Northzone and his contemporaries across the venture capital world, we don't really exist as an entity, certainly not doing early stage lending. So we work extremely closely together and collaborate with not just Northzone, but VCs across UK, Europe, and the globe, actually. So to get to know each other, figure out what the interesting companies are, where debt's going to play well, and equally as importantly, where it isn't. And then trying to identify the best opportunities and figure out the best structures and the best way of getting things done. And I'm sure you'll have things to add to that.
Yeah, actually, I know when I was on the founder side, my image of venture debt it was like your last resort. You know, like the thing was just not working. I'm going to get these sharks in here. They're going to write me this term sheet, and then if things don't go well, they're going to own the company. I literally, you know, that was a while ago, but I had that perception. Yeah. And I think now, well, I saw, because I raised some debt as well in my last venture, and you know, now I look at it completely the other way around. It's actually, if I want to be greedy, if my business is doing well, I don't want to give more of it away. How can I kind of delay the next fundraising with the right debt provider?
Exactly, and that's where debt can be super useful. As I just said, it's not great in every occasion. I mean, if you're a super early company, I was lucky enough to be at the Kibo Ventures event yesterday, watching Paul host a panel, and it was around mobility and future of cities and things like that. And there's a lot of talk around sort of real, what we call frontier tech, so the outlier stuff, things that, you know, flying cars, flying taxis, flying scooters, things like that. Hopefully never see a flying scooter, but this is the kind of situation where it's a bit more of a punt. So debt maybe looks a little bit less like a good idea, because you don't have any kind of certainty around when you might you get your MVP, when you might be able to sell it, how much you sell it for, and all the kind of metrics that actually make a good cash flow.
Yeah. This is quite interesting because, and Paul was mentioning, no, debt in this case is not to substitute equity, but to complement equity, no? So you typically are raising debt on top of your equity round, no, on your equity needs, and not in order to substitute the kind of investment that you need, no? I don't know if you can explain a little bit about that, no, and why it works in this sense.
Yeah, I guess the use case for us, and I'm sure you'll have a view, is there's essentially two. It's either runway extension, or it allows you to run a bit faster. So with both intentions being, when you come to raise your next round of equity, you're hopefully looking at a company that's got higher revenues, all the metrics are higher than they would have been if you didn't have the debt there, and so therefore you're looking at a higher valuation, so giving less away. That's how we would advertise it, sell it to founders, and that's what tends to be the attraction. But you know, venture debt's not the only way of doing it. We also have an assortment of other products which are more scalable, which can live with the company for longer, and actually provide an ongoing sort of substitution for equity. So you have to, the cost of equity capital is much higher than the cost of debt capital. So if you're a founder, debt can be useful, but obviously it needs repaying. So you have to think about that when you're thinking about putting it in place.
And I actually I sort of warned James was going to talk about this, but you know, if I think back maybe 10 years ago in New York, when the concept of venture debt came up, there was relatively little knowledge. And I think now it's part of the conversation. When you're going to raise a round of financing, you know, you think about equity and debt. I think here, what I've noticed, even similar in London, it's still a bit misunderstood as to when to use it. And I think it would be helpful to hear from you, like, what are some of the restrictions that debt provides? So we hear these words thrown around like covenants, and you've got interest rates and warrant coverage. What does all that stuff mean? It's helpful for people.
Yeah, good question. So there's a lot of different iterations of debt around in the market, and also, you know, Silicon Valley Bank and our competitors will have different products which are useful at different stages. Taking venture debt as an example, ours has no covenants, which means it's extremely flexible cash. So in essence, unless you fail to repay the loan, the bank has no step-in rights. It can do nothing at all.
And just to kind of rephrase that a little bit, but it's my understanding that is like covenants were basically, if you're, you know, one of the covenants could be a cash reserve in your company. And if you fall below a certain threshold, you have to repay,
which can tie a company in knots.
Debt. Yeah, exactly. Well, then you think about it. I need the debt. Now you're pulling it away from me at the last possible moment. So you're saying you don't have any of that?
No, typically, no, we don't. So a lot of the time, companies come to us and they'll have signed up to a facility where they have some kind of minimum cash covenants. And of course, to your point, that's exactly when they need the debt. That's why they want it. And they haven't got the cash, so they need the debt, and they can't get it because the covenant's there. So and we try and help them out in that situation. So you've got to be careful. There's all sorts of terms and restrictions, and you know, you may have things that go on in the market are things like, if you repay the debt early, you may end up paying all the interest and fees due on the arrangement that would have been incurred had it run to the end. We don't typically do that either. So there's things to watch out for. When you're talking to a bank versus a fund, there's differences, I would suggest, because there's lots of competitors out there. I think if you are thinking about debt, my advice would be talk to as many people as possible and just get some options.
Yeah, and I think one of the things I would say, which is there's at least in the States, there's a difference between regulated capital and unregulated capital, and so sometimes the unregulated debt providers can be. I realize this may not be beneficial to you, sorry about this, but they can be sometimes more flexible. You will typically pay for that with higher interest rate, higher warrant coverage, but it depends, I think, on your specific situation, whether you want to go regulated or unregulated capital.
Yeah, absolutely. And if there's anything you don't understand, I mean, I don't think we don't have the time to explain everything about a debt term sheet here right now, but just make sure you do understand. If you're looking at debt, ask your lender, ask your lawyer, ask anybody who understands, and particularly ask people who've been there and done it before and see what their experiences are.
So very, very interesting, and especially for the Spanish ecosystem, that probably we have lack of good experiences, no, around big venture debt rounds, no. You create when you enter, no. This is the main question, no. You are a company that is performing quite well. They are trying to raise a Series B of 10, 15, 20 million euros. You are talking with different international VCs in order to create the syndicate, to create the deal. When is the best moment to talk with you guys as venture debt? You need to talk before having the round on the table. At the same time, once you have the commitment from the term sheet from the lead investor, what is the right time to be in touch with you, no, in this?
I'll answer this in an investor-friendly way. We never want the debt to get in the way of raising the equity, because both of these things take time. So if you're not serious about the debt, don't engage, don't go down the path, because it will tie you. Raising an equity round is hard enough for an entrepreneur. It's difficult. It takes a lot of time. So don't have a debt conversation unless you think you need to. In terms of timing, we would always encourage entrepreneurs or companies to come to us at the earliest possible stage. So just setting the scene, we can discuss what the art of the possible may be. If you're raising your 10, 20 million equity round, can I do debt alongside it? Yes, probably. And we'll structure it in such a way as you get the cash much later when your runway's short. But have the conversation early. To answer the question the other way around, the worst time to come to us or any of our competitors is when you are about to run out of cash. Don't come to us then.
Yeah, I had a sort of experience where actually my last company was a game studio, and we had raised our equity round, and then our revenue started growing, and then actually became break even, and eventually became profitable. And we actually went off cycle, so no equity discussions, and then just went to the debt providers because we were basically paying to acquire users that paid back in 6 to 9 months. And so it felt, if we wanted to really sort of put our foot on the gas, it felt pretty silly to raise equity for that bit of working capital. So we sort of canvassed the market of debt providers, and it was interesting. Some of them were super aggressive. Here's a term sheet, friendly terms like what you discussed. Others actually said we only needed 2. They wanted to give us 10. And more, a little bit more free kind of flowing debt that we didn't really want. So I think there's a lot of options, and I would say it doesn't always have to be tied to an equity round. Yeah. In my experience.
And I'd add, it's a really good point that you make around how much should you look at raising in terms of debt and equity, actually. But we're talking about debt. What you've got to bear in mind is that your cash runway will get you so far, then you put debt on top, and that will get you so far. That's always assuming that you hit your plan. Okay, right? If you drift off your plan, which can happen most of the time, then you're going to end up with some kind of wall of debt at the end. And the bigger that is, the harder it's going to be for you to refinance at the next round. So what we like to do at SVB, and a lot of people are like this, is we like to kind of evaluate where a sensible amount of debt would be. So our debt does amortize. You will repay it as you go through the term of the loan. We don't do bullets. Some people offer you bullets. I wouldn't suggest that you take them because, apologies for terminology, it basically means the loan does not amortize. So 3 million in day one, 3 years later, whatever it may be, 3 million still there. You've just paid the interest. So you have that 3 million, and that's a refinance issue. So you either need to find your existing lender to refinance it, or you need to find an equity provider to take it out. and that can be complex. So these are just things to bear in mind.
One interesting, and talking especially for venture debt solutions, is one of the main differences for, if you compare with traditional debt services, is that most of the time you are not repaying the debt through your own cash flows. You are acting as a way to have more cash on the table, and probably once the company raises the next round, you renegotiate the terms of this deal, or once the company is sold or have an IPO, so you can convert or you can renegotiate or pay back the debt. What happens when things are not going as well? No? And how there's and why you have this relation with venture capital firms? No? This is the two questions for you, James.
Absolutely. Shall I take it first?
Go for it.
So this is where the partnership is key. We get asked a lot at the outset of a debt facility, of a debt conversation. What will happen if it goes really well, or particularly if it doesn't go so well? So the company hasn't performed as well, and so the debt is looking a bit more like a potential problem. This is where we start to talk to Paul as an investor and the board. So typically, venture debt would have multiple VCs on the board, on the cap table. So we've got multiple people to speak to. The important thing is that we're all working in alignment, and we all have the same objective. And whether that is to get the company to a point where it's maybe sold, so whether it's to get it to a point where it can raise more money, or whatever it may be, or the worst things, the worst thing happens, the company just doesn't work at all, and we all walk away. But the key thing is, we talk to each other when we understand, and this is where the partnerships that we've built up over many, many years are absolutely fundamental.
Yeah, I think just to jump in there, I mean, there is absolutely, just like there's tier one venture capital funds, like Northstone, others, there's tier one venture debt funds. And I think that's really important to understand because it is not all the same. I have seen a situation in the past 12 months where a venture debt facility could not be serviced. Actually two, one that couldn't be serviced, and it was renegotiated, and the business is good and healthy, and it should. That was the right outcome, and that was a tier one fund. There's another situation that's not a Northstone portfolio company, but I did see it through a friend, and it was not a tier one venture fund, and they didn't sort of restructure that, and the business is insolvent, and it shouldn't be insolvent. And so I think that was the cheaper provider. I think that person learned a really painful lesson.
Yeah.
Okay, we have 2 minutes for a final advice. No, you have here a lot of entrepreneurs, some investors, and probably some service providers that are helping the companies to grow. No? What is one final conclusion, no, regarding considering debt or considering venture debt as an option of financing?
For me, being realistic about the life stage of your company, and considering that for most venture debt providers, you're going to need at least one institutional venture capital fund that you're working with. You've probably raised multiple millions in equity, and you've probably got good revenue traction. I mean, at SVB, we don't actually have any minimums. We would do venture debt in isolated circumstances to companies without any revenues at all, but it's unusual. So we're looking for there to be good metrics, good proof points, because all of this lends itself to a more foreseeable, visible future cash flow, where the company knows what levers it can pull, what will happen if it pulls them, and it just starts to look like a much better opportunity. So I'd say, and also just when you go to a bank, it's like going to any bank or any organization, just make sure you come prepared and just have good information, accurate information that you can stand by.
So I was talking to a serial entrepreneur just before this, and I asked him what he thought I should sort of say, because I was kind of curious, and he had a really good point, which is as a founder, you realize very quickly that your job is all about sales, and you're selling, employees that you're recruiting to, you're selling customers you're going to sell to, you're selling investors, and so fundraising is going to be a core part of your job, and it's never really done. And I would say in that spirit, think of your job as a fundraiser for your business to not just be talking to VCs, but to be talking to all sources of capital. By the way, including your bank, because there may be a time when you need just a traditional kind of AR revolver and your bank can provide that facility. But you sort of always need to be thinking about where and when and how you're going to finance the business, would be my advice.
So, James, Paul, thanks. For CaixaBank Day One, it's a pleasure to have them on board, because one of them, our main missions is to connect the local ecosystem with the best global providers. No? So, thank you very much.
Thank you.
Thanks, guys.